Hello, everyone. Welcome once again in our discussion of the risk financial institutions are exposed to. In this video, I'll be talking about foreign exchange risk. Financial institutions have increasingly recognized that both uh, direct foreign investment and foreign portfolio investment can extend the operational and financial benefits available from purely domestic investments. To the extent that the returns on domestic and foreign investments are imperfectly correlated, there are potential gains for a financial institution that expands its asset holdings and liability funding beyond domestic borders. The returns on domestic and foreign direct investment and portfolio investments are not perfectly correlated for two reasons. The first is that the underlying technologies of various economies differ, as do the firms in those economies. For example, one economy might be based on agriculture, while another is service industry based. Further, given different economic infrastructure, one economy might be expanding while another is contracting. The second reason for the lack of perfect correlation in domestic and foreign asset returns is that exchange rate changes are not perfectly correlated across countries. This means that the Australian dollar, Singapore dollar exchange rate might be appreciating while the Australian dollar, Japanese yen exchange rate might be falling. Now, foreign exchange risk is the risk that exchange rate changes can adversely affect the value of a financial institution's assets and liabilities denominated in foreign currencies. To understand how financial institutions exposed to foreign exchange risk, suppose that an Australian financial institution makes a loan to a British company in pound sterling. Should the UK pound depreciate in value relative to the Australian dollar, the principal and interest payments received by Australian investors would be devalued in Australian dollar terms. Indeed, were the UK pound to fall far enough over the investment period when cash flows are converted back to Australian dollar, the overall returns could be negative. That is, on the conversion of principal and interest payments from pound sterling into Australian dollar, foreign exchange losses can offset the promised value of local currency interest payments at the original exchange rate. In general, the financial institution hold assets denominated in a foreign currency and or foreign liabilities. Consider a financial institution that holds 100 million loans as an assets and funds 80 million of them with UK pound certificate of deposits. The difference between, an Australian financial institution holds 100 million of loans in UK pound and funds 80 million of them with UK pound certificate of deposits. The difference between the 100 million in loans and the 80 million in CDs is funded by the Australian dollar CDs. That is 20 million Australian pound worth of Australian dollar CDs. In this case, the Australian financial institution is net long 20 million in British assets. That is, it holds more foreign assets than liabilities. The Australian financial institution suffers losses if the exchange rate for UK pounds falls against the Australian dollar over this period. In Australian dollar terms, the value of the UK pound loan assets falls or decreases in value by more than the UK pound CD liabilities do. That is, the financial institution is exposed to the risk that its net foreign assets may have to be liquidated at an exchange rate lower than the one that existed when the financial institutions entered into the foreign asset liability position. Note that the financial institutions is fully hedged only if we assume that it holds foreign assets and liabilities of exactly the same maturity. Consider what happens if the financial institutions matches the size of its foreign currency book, UK pound assets equal to UK pound liabilities equal to say 100 million in that currency, but mismatches the maturities so that the pound sterling assets are of 6 months maturity and the liabilities are of 3 months maturity. The financial institutions would then be exposed to foreign exchange rate risk. The risk that British interest rates would rise when it has to roll over its 100 million UKCD liabilities at the end of third month. Consequently, and financial institutions that matches both the size and maturity of its exposure in assets and liabilities of a given currency each hedged or immune against foreign currency and foreign interest rate risk. We will be discussing more detail about foreign exchange risk in future weeks. Thank you very much.